Source: Adobe/Make. Impressive growth in the decentralized finance market since the start of the year has shown us that there is a high demand for yield generating protocols, despite the risky nature of these new financial products. DeFi's value proposition is easily apparent. Borderless access to a host of financial services provides the user with a significant upside while simultaneously increasing their financial sovereignty. Financial inclusion, cost efficiency, composability, and readily available liquidity are among the opportunities created by various DeFi projects. Even if, for now, it is mostly about yield generation and high risks. These risks are typically grouped into four major categories: coding risk, oracle/centralization risk, financial risk, regulatory risk. Coding risks refer to the attack vectors that can be exploited due to the underlying code that supports the protocol or platform. DeFi is simply a suite of software, created by lines of code, that supports a host of financial services. Given the complex nature of DeFi protocols, it is not uncommon for there to be errors in the code that can provide malicious parties with an attack vector through which they can steal funds, and they do. However, outside of the obvious risk of losing funds through a hack, coding risks also pose a significant risk to the greater DeFi ecosystem. Due to the composability in DeFi, if one protocol is unstable, there may very well be a risk for the entire connected ecosystem. In its most recent report, the third Global Cryptocit Benchmarking Study, the Cambridge Center for Alternative Finance explained this risk, stating, "Stacking and composability of smart contracts also pose a risk. Should an underlying smart contract break, then the stack may fall like a house of cards." Oracle/centralization risk. Many of the protocols within the DeFi space are dependent or make use of a centralized tool. Due to the very nascent nature of the DeFi sector, the developing teams have systems in place that confer certain power to a centralized party to reduce inefficiencies or reduce attack vectors. Ironically, while these centralized systems provide the developing platform with some advantages, they are also a significant risk for the functioning of the ecosystem. Learn more why DeFi isn't always as decentralized as you might think. Take, for instance, oracles, which are leveraged by a number of automated market makers, and decentralized exchanges, as typically receive data from a single source. This can pose a risk as it is trivial for a malicious party to take control of the singular source of data and manipulate the market to their profit. While it is important to note that most developer teams are focused on phasing out the centralized aspects of TH. You can read full post on CryptoFans News, link available in text below.